All right, now in this video, I want to go over, can we still retrace? Oftentimes, the retracement that we make actually makes it low probability. So for our entry, for example, we would want more confirmation. Or if we are already in the trade and we are managing our risk, then we want to go break even because the retracement actually shows us, hey, this price action is something that we don't want to be involved in. It is low probability if we now make the retracement and don't follow through. All right, then I also want to mention right here that the finishing touch month is based on mainly individual videos, but the previous two videos right here, so number 2 and 3 of the finishing touch, they do really help with understanding this topic right here today. Okay, then let's move on. We have two scenarios. The first one right there is in the fair value area, breakaway gaps in a trade or risk management is what we're going to go over. Then the second one right there is a new fair value area in a trade or risk management. So the first one is whilst we are creating the fair value area. The second one is whilst we have created the fair value area, how far can we then retrace? Okay, let's dive into the chart. Here we are on GBP JPY on the 1 hour time frame, and let's say that we are trading off that 4 hour fair value gap right there to potentially continue higher towards this context high right there. And on the 1 hour right here, we see that we had a few entries opportunities. Let's say this right here was the entry. So now we are managing our risk actually right here, for example. And we're in this trade and we target that high or even higher. Doesn't really matter. We're in this trade right here. Let's put this to the side. Then how can we go about this trade? How far can we retrace? Now right here, we start pushing higher on the 4 hour since we're working with 4 hour context. Based on the previous video, we expect inside the context area right here to form breakaway gaps on the 4 hour and 1 hour most likely, right? Doesn't always have to happen, but most likely that is where the breakaway gaps are going to form until we then reach the high, the context high, and then we can have a retracement right there. Now we are creating a fair value area right here because this is a fair value area. So if we were to reach above it right there, then this would be the fair value area. So we're inside that fair value area. Why is that important? Because that's important to understand. That's also the reason why we then create breakaway gaps. Why? Because everything here is already fair value. So if we are about to continue higher right there, then most likely it's going to happen quite fast without a lot of retracements like we are seeing currently. We're not going to consolidate. Again, we always want to be aware of the fact, okay, we might create a consolidation right here. And that is exactly what we want to avoid because we don't want to get caught up in a consolidation, which this understanding will also help with that. So once we start pushing higher right here, and we start to create this fair value gap right there, which I would argue at that moment in time is a breakaway gap because the third candle here is already a new push higher right there, which is seen by the 15-minute right here. 15-minute is already creating new fair value gaps continuing higher as well. So the 1 hour, whilst we are in this trade right here, can already be break even. Why? Because ask ourselves, do we want to see this retracement to then continue higher? No, this should ideally follow through fast with the 15-minute of 4 hour context showing us the most fair value gaps that we can sting back into to then continue higher off of that. So the retracement here actually makes it low probability. Now, a question that I like to ask myself is if we are already in a trade, for example, would I be willing to enter if price came there? So what I mean by that is, would I be willing to enter a new trade right here if we get this retracement? And no, I wouldn't, because I expect price action right there to be fast, to move higher fast right there. So the fair value gaps here are already lower probability to enter off of. That's not something that I am interested in right there to enter off of. And if we dive into the 15-minute, we can see something as well interesting. We continue higher of a 15-minute context. So we have 15-minute context right there. Now on the 15-minute, we again create new 15-minute context right there. This retracement is actually also low probability. Why? Because inside that 15-minute context, we should have 15-minute breakaway gaps ideally, right? So why are we retracing? That retracement happens because we're truly not that bullish. We don't have the full bullish intention at that moment in time. So this is where we want to be extremely careful with entering again. And then afterwards, we get a bigger retracement whilst everything starts to fill essentially. This is not a retracement to continue higher. If this is a retracement, there's two things that we can do. We can either continue lower or we're about to consolidate. And neither of those things are good for our trade ID. So we can already go break even without expecting a retracement into that fair value gap. So a really good study for this inside the fair value gap, go to the previous trades that you took, go over them. And look at the scenarios where you took a loss or took a break even, for example, or even took a winner, all the trades. And then look, okay, was there at that moment in time a reason to retrace? And in your winning trades, well, most of the time you will see, okay, we just have fast price action continuing higher. And then your break even trades right there, if they are not missed winners and they are actually prevented losses, then you'll see there was no reason to retrace. And the losses, if you manage to get break even or if there was an opportunity to go break even, you'll oftentimes see the same. Now, of course, when we are already in a trade right there, then we need to be careful. We need to be careful with not going break even too early. So my advice is use this video to practice on your previous trades that you took. Then use the video to understand it for your next trades as well. You might take some break evens that end up being winners, and then see where the balance, see where the sweet spot is right there. Because usually it's the case that people they tend to go break even a little bit too early. And with experience, if you experience going break even too early, and that translates over to missing winners, it's of course not what we want, then we tend to become a little bit more loose, and we need to find that sweet spot right there. That is very important to understand as well. All right, now if we have the first scenario right here that we're already in a trade, so we have gone over the risk management essentially, then it's the exact same thing as if we were to enter a new trade. So can we enter a new trade off this 1 hour value gap? No, because that, the exact same as the risk management variation right there, would make it low probability. We would not want to see a retracement right there happen coming back to the 1 hour value gap. So that would make it low probability to actually enter off of that 1 hour breakaway gap right there. We don't want to see that. So that's why we ask ourselves the question, would I be willing to enter if price came there? And if you're not willing to place a new entry, then why leave the position open to not go break even? Because if you're not going break even, you're essentially just leaving a new entry on. Because if you're expecting price to come there, then you're essentially leaving a new position open for your stop loss to get hit. So that is why we ask ourselves the question, would I be willing to enter if price returned to that discount array or that premium array right there? So here we are on the Euro US dollar on the 4 hour time frame, and we have just created this fair value area. So what GBP JPY failed to do thus far, failed to follow through higher right there, Euro US dollar has done. So we create the fair value area right there. Now the fair value area is very similar, where if we now create a retracement and it's a very deep retracement, then of course we know that it might start seeking liquidity. So entries off of, for example, order blocks all the way at the bottom right there, are they high probability? No, because the lower the discount array in this fair value area, that also means the deeper the retracement that we currently have. That also means that we're not offering any fair value, but that we might actually be seeking liquidity in the form of this low right here. So the retracement that we have at this moment in time with that expansion phase candle, that retracement makes the whole idea of potentially continuing higher off the fair value area extremely low probability. So that's what we have to understand, that we would not want to place a new trade at that moment in time. Then if we take a look right here, and we do decide to enter off that 4 hour value, for example, right there, and we expect higher prices, then we know as soon as the full rejection right here starts to fill, that the whole thing most likely starts to fill, as in we have a dominoes effect. The fair value area right there most likely is going to fill as soon as that 4 hour value gap right there fills. So what do we want to do? We now can get extremely advanced, and we can almost get very picky on our risk management. And what I mean by that is we want to see a new fair value gap getting created immediately. Any retracement or anything that does not create a fair value gap and we get a bigger retracement is already low probability. So for example, right here, once we have this big long wick at the top right there going higher, that tells us price came up right there, came all the way down. So we can already go break even right there quite early on, because there's no reason to retrace anymore right here. We are most likely just consolidating. And when we do get a retracement, then what do we see? We start seeking liquidity. We should continue higher off that fair value area quite fast right there, not create those weird retracements back into the fair value area. Now, another example that I want to go over is silver right here. We have this fair value area, which we can potentially continue higher from. Let's dive into the 4-hour time frame. On the 4-hour time frame, we see the first rejection. Let's ignore that one. Let's look at this rejection right here. We get a 4-hour sharp turn. Let's say that was our entry. Either was a direct entry, orderful entry, or was a stick entry right there. Now, if we enter, let's use a stick entry actually. Let's use a stick entry right there. And let's leave our stop loss somewhere like that, just for the example's sake, right here. Let's move it to the side. Then right now, if we are in a trade, well, let's first go over this scenario. We have this fair value gap right there, and we have this fair value area right there, the fractal fair value area, which we can potentially continue higher from right here. Now, at this moment in time, we are coming off a weekly fair value area right here, and we can just simply look to continue higher. We have a lot of momentum going for us right there as well. There's no fair value gap below us or anything. There's no daily value gap right there. So we don't have to worry about that. So right here at this moment in time, if we look to enter off of anything, can we enter off of this 4-hour value gap? I do believe that retracement is doable. There's not a crazy retracement in my opinion. Afterwards, if we were to come back all the way towards this fair value area, is that a valid retracement? I don't believe so. Why? Because it retraces very far and very aggressive right there. If we do still want to continue higher, it doesn't make a lot of sense to create that retracement right there into that fractal fair value area. So this already tells us, would we enter would we enter a new trade if we were to come back into that fair value area? Well, most likely not, because that's a very deep retracement to make if we do still want to continue higher and we are moving inside that weekly context. So that doesn't make a lot of sense. Okay, then if we are already in this trade right here, if we were not to place a new entry right there at this level, then that tells us that we should be break even right there. We should be break even right now because there's also no reason to return anymore. Because if we're not placing a new entry, then there's also no reason to return anymore. So the first we can retrace is that 4-hour value gap. Once that starts to fill right there, everything starts to fill right there. And again, this is where practice comes in. Because now it's important to understand, you need to practice to see how far we can actually retrace. Again, like I mentioned in earlier finishing touch videos as well, I can mention this in a video, but you'll never truly understand it if you don't go ahead and make a case study or apply it in live conditions. And that is very important to understand. So this is where a lot of times people can also go earlier, break even than they think. But again, find that sweet spot, because when you start applying this, most likely you're going to go break even sometimes a little bit too early. And there's nothing wrong with that, because that's the learning process. It's a learning process, a learning curve that we all go through. So no worries about that. All right, perfect. Thank you.